YouTube, welcome back. Dub Digital Crypto News, Macro Trends. Give me a subscribe if you appreciate that content. I'm trying to bring you the hottest crypto content on the internet. On the weekend, guys, I like to do a little something different to improve our investment arsenal, our investment tool belt, so we could come back stronger and better the next week. Today, we're going to talk about position sizing. Dub Digital, I came here to learn about crypto. Well, guys, if you take the time to learn some of the basics, over time, you'll make less and less mistakes, which means you lose less and less money, and you actually start making more and more money and understanding what you're doing. And that, guys, is an investment that will outshine any kind of crypto investment you can make, because it's an investment into your mental capital. It's an investment into your tool belt. Let's get into it. Dub Digital, I don't want to learn money management, bro. I just want to make money. I don't want to have to put it in the hard work. I just want to become a crypto millionaire and drive my Lambo to the moon, bro. What the heck is this? Guys, no one said this was easy. Anyone told you it's easy, they lying. But welcome to my channel. I ain't lying. If you want to become good at it and make more money than you lose, it pays to invest in your mental capital. So with that said, let's get it. Core holdings. Why are you showing me core holdings? I thought this was a position sizing. Let me set the stage. I'm showing you core holding. I want to explain to you what they are. It tells you what kind of investor I am. Core holdings are the central investment of a long-term portfolio. When building a portfolio, it's essential that core holdings have a history of reliable service and consistent returns. So let me put it this way, guys. I invest over months and years. In the spectrum of investors, I'm considered a longer-term investor, especially in the crypto space, because everything is accelerated in the crypto space, y'all. Core holdings in a well-diversified portfolio tend to outperform a portfolio consistently entirely of growth stocks. So what do I consider a core holding? What do I consider in the crypto space to be reliable service and consistent returns? BTC, baby, the bedrock. It has resiliency. It's labeled digital gold for a reason. Core holdings in a well-diversified portfolio tends to outperform a portfolio consistently entirely of growth stocks, aka altcoins. A portfolio with core holdings that are consistent and reliable will benefit from stable growth in safer sectors of the economy, while also taking advantage of growth opportunities in its non-core investments. If you guys follow my channel at all, this is exactly why I'm a big proponent of portfolio management within cryptocurrency. Looking at your cryptocurrency portfolio as a breakdown between safer crypto investments and more risky crypto investments. Bitcoin is a huge percentage of my portfolio, but I'm equally weighted to growth stocks, or in this case, in the crypto world, altcoins, because altcoins over the duration of bull run have been known to have much more prolific, much higher gains percentage-wise than Bitcoin. So in this way, I'm capturing resiliency, stability, ability to capitalize on opportunity if it presents itself in the growth sector, and equal weight exposed to growth. And in this way, I manage my money. And as Bitcoin moves up in price, as Bitcoin defies gravity, defies the odds, tells all those haters to shut up, Bitcoin becomes a bigger and bigger percentage of my portfolio. And I just ran across a situation where my portfolio gained 3%. Knowing my current asset allocation, 50-50 split between Bitcoin and altcoins, I then know that I have 3% where I need to rebalance. Dub Digital, what the heck is rebalancing? So basically, in very, very simple terms, rebalancing is when your portfolio, whether it be Bitcoin or altcoin, gets out of whack. You want it to be in the whack, know what I'm saying? We take that 3% and reinvest it into the depressed altcoins, so we are back in harmony, y'all. And I love it when my team's in harmony. So now we set the stage, guys. There's lots of ways to do it, but I want to explain to you how I do it, and the way I look at things is to derive your investable money from an overperformance in a sector of your portfolio. This is how money managers handle big money, guys. Big boy money. Preservation of capital is just as important as making capital. Do you dig? Let's go to it. Dub Digital, it's all good that we overperform 3% on my portfolio, but that's not my problem, bro. My problem is I don't know about position sizing. How do I know my bet is too big? Because I don't want to sleep on the couch and drink vodka for dinner. What is position sizing? Position sizing refers to the number of units invested in a particular security by an investor or trader. An investor's account size and risk tolerance should be taken into account when determining appropriate position sizing. All right, Dub Digital, I see you. What's risk tolerance, though? Risk tolerance is a measure of how much of a loss an investor is willing to endure within their portfolio. It looks at how much market risk, stock volatility, stock market swings, economic or political events, regulatory or interest rate changes an investor can tolerate, considering that all these factors might cause your portfolio to slide. How much you risk in a trade is directly correlated to how much money you are willing to lose, and that has a lot to do with what stage of life you're in, what kind of responsibilities you have. There's a lot of things that are individual to the investor, that it pays to know yourself and really think about, do I need this money? When will I need this money? Can I handle big drawdowns in my portfolio? Will I panic and sell at the bottom? Or am I just investing way too much money I don't have the experience to invest, and it takes a big person to admit they're in over their head? But I'll let you guys think about that and we'll move on to some strategies. Let's do it. Okay, but like what risk? Like tolerance to what risk? I don't get it. Before an investor can use appropriate position sizing for a specific trade, they must determine his account risk. This typically gets expressed as a percentage of investors' capital. As a rule of thumb, most retail investors risk no more than 2% of their investment capital on any one trade. Fund managers usually risk less than this amount. And see guys, this is good perspective. Let it sink in. Whenever you hear people telling you to bet the farm, you can do that. And there's people where it's worked out for them, but it's not the norm, and it's definitely not what professionals do. You could wish upon a star and hope that a once in a million thing can happen to you, or you could follow the formula. But Dub Digital, I don't get it. Like retail investors risk more than institutional investors and big money managers? Yeah man, that's the way it's always been, because big money understands that this is a game of probabilities, and in order to really achieve and come back, you have to be able to get through the low points. And sometimes you lose trade. Sometimes the Fed changes policy on you and the stock market goes down. You can do all the TA in the world, doesn't matter. The experienced investor realizes this, acknowledges this, and positions his strategy to this, because the probability of you missing out on 10 good trades is very low. For example, if an investor has a $25,000 account and decides to set their maximum risk at 2%, they cannot risk more than $500 per trade, which is 2% times 25,000. Even if an investor loses 10 consecutive trades in a row, they have only lost 20% of their investment capital. Bada bing, bada boom. Longevity, guys, is more important than gains. Just saying. But not financial advice. So Dub Digital, what does this mean for me? I don't understand what it means for me. Well guys, if you took that position and you combined it with my portfolio management kind of thesis, where when your ratio overperforms on one asset, you take that overperformance and reinvest it into the sector that's underperforming. In very, very official investment terms, this is called the fixed percentage risk method. You establish a percentage based off of your criteria, which you will never go beyond. And this will keep you in line from going too ham, from going too hard in the paint. And I think in our mock situation, we overperformed 3%. So I grabbed that 3% and now I look at it as an entity, as a portfolio of its own. So basically I made a chart here that illustrates this. 3% overperformance of that BTC sector in our portfolio. So now we're looking at it, we say we got some money to work with. That basic rule of thumb of never taking more than 2% on a given trade, that really plays into the probability of the situation. Okay, so basically out of this 3%, we're looking at 2% for the next current trade. We're analyzing the chart, looking for a good setup, dropping 2% in that chart. Then we're looking for the next setup and the next setup and the next setup, because you're using that 2% as ammo. And just based off a simple probability, you know that if you get into enough trades with enough attractive setups, some of these are gonna explode, some of these are gonna go to zero. But Dub Digital, I don't do a lot of trades, man. I just like do a couple. If I do this at this rate, I'm never gonna get my capital deployed. I understand that as well. Let's go. Or basically you just want to limit your tax liability and not do a million trades so you owe the government $1 million. Maybe this one's for you. It's called averaging down. It needs to be done intelligently. You need to understand what asymmetric risk is. But Dub Digital, it's Sunday and I don't know what asymmetric risk is. Why are you making me think like this? An asymmetrical risk reward situation can be both positive and negative. Positive one is where you can only lose an amount that is smaller than the potential reward. And you see a diagram down here. Current price is $100. The asset could drop to $90. That's a $10 loss. It can rise to $180, which is an $80 gain. As investors, we like to focus on positive asymmetric risk. But Dub Digital, what does positive asymmetrical risk look like? Not financial advice, y'all. Y'all are adults. But this is WAN chain. It can go down like, I don't even know, not that far, but it could go up thousands of percent. OXT, from the floor, 20% down, but can raise 300% plus. I could keep going on and on, but you catch my drift. Whenever something's down on the floor, probability states that it will rise and rise farther than what it can drop if it's dropped severely. That's why I tell you guys buy low, sell high. It ain't sexy. It ain't what you want to hear, but it's what works. Some people seem like they like negative asymmetric risk, where they buy at tops and let it drop on them. Every action has an equal and opposite reaction. Let's get back to business. So with that said, guys, please use this sparingly. Please do some analysis on the chart to understand that this price that you will invest in is depressed, because if it's not, it could drop from under you. You want to be in a situation where the probability is in your favor, not against you. Averaging down. The position sizing strategy is quite a dangerous one and should be used with caution. Averaging down means that you keep adding contracts and shares if the market moves against you. By doing so, the average price decreases and you reduce the amount that the stock must rise for you to make a profit. And it's basically what I've been saying to you guys my entire channel. If you buy up here, it drops down. You can buy down here and buy down here. You take the average and it's probably somewhere somewhere along in the middle. Averaging down is used most with mean reverting strategies, and that is also where they make the most sense. Exactly. The more oversold a market becomes, the greater the chance that it will revert soon. Still, one has to be vigilant. In the case of a black swan event, averaging down could cause massive losses and should be used with caution. But Dub Digital, how do we know? How do we know that like crypto can't drop from under us? To put it quite simply, every good investment isn't a good investment all of the time. Sometimes when things go way up here, like crypto market cap did in 2018, it can drop about 90%. If you got in around here, like some of us did, you could have rode this thing up about 1,000%. That same story is very different for the person who got in here before the run up when the asymmetric risk was positive. Same assets, same market, but different perspective in between investors based on when they entered that market. Because we don't FOMO in this channel, guys. We don't do that. We're anti-FOMO, man. Right when everyone was hating crypto between October 18th and January 2019. Awesome time to pick up crypto. Right around here when the stock market crashed and the pandemic hit the scene. Great time to pick up crypto. Right here when we started seeing Bitcoin lifting off, higher highs, higher lows. Not a bad time to pick up crypto. There's times to accumulate and times to wait, guys. It helps to look at investing as a process that doesn't run on your timetable. That's how you must look at this when you're practicing the averaging down method. Alright guys, just wanted to bring to you two of the most useful position sizing strategies that I've personally used and like to use in my style of investing over the time that I've been in cryptocurrency market. If you're more of a high frequency trader, get a lot of volume in, the rule of thumb traditionally is no more than 2% of your pool of money that you want to reinvest into the market. If you're a longer term investor like I am that invest over months and years, then I like to average down because I'm patient. It's called patient money. When you're waiting for the market to come to you, to come back to reality. And when it does, always play to your strengths, guys. Always play to your strengths. If you appreciate the content, give me a like, comment, subscribe, Dub Digital. Crypto news, macro trends. I'll talk to y'all later. Peace.